Billionaires understand that a tax saving strategy is actually a wealth building strategy because paying a lot of taxes literally prevents you from building wealth. So today I want to show you how to avoid paying taxes like a billionaire. Now, if you are an educated taxpayer, then you've probably heard that the richest Americans pay less taxes than the average citizen.
Teachers and nurses and firefighters are paying a higher tax rate than billionaires and the biggest corporations.
But I'm paying about the same percentage of my income to the federal government as my secretary does.
So how exactly is this possible? It's not like the tax code specifically states that you have to be a billionaire to take advantage of it. Technically, anyone can use the tax code to reduce their taxes. It just so happens that the richest among us are the best at doing so.
He didn't pay any federal income tax. So
that makes me smart.
Now, contrary to popular belief, a lot of wealthy individuals who pay very little tax are actually not cheating the system. There have been numerous leaks of IRS records that indicate how the wealthiest Americans use the tax law to reduce their taxes, and it turns out that they are simply taking advantage of very straightforward rules in the tax code. And these provisions are available to really everyone. So as a licensed CPA that fully understands these rules and tax plans every day at mycpacoach.com, I want to walk you through this. Not only are you going to learn the tactics that billionaires use, but I'm also going to give you real world examples of these tactics in practice, and more importantly, how ordinary taxpayers can use the same exact strategies. So comment below and let me know what you think, and let's go ahead and get this started. Okay, so in order to avoid tax like a billionaire, you need to structure your wealth building strategy like a billionaire. And you don't need billions of dollars to do this. You just need the right framework to build on from where you are today. Specifically, we need to carefully structure how we earn income, how we invest that income, and how we assess that income. So let's lay the groundwork of how we can accomplish this. First, the most fundamental component of this entire concept is that you need complete ownership of how you earn and report your income. And when I say ownership, I am talking about equity. I'm talking about owning assets. For example, when you own a business, rental property, or even investments in your stock portfolio, you have equity. You have assets. And as those assets grow, you have more flexibility to determine how you will be taxed. For instance, you can borrow against those assets and never pay taxes, which we'll talk about. Or even if you do sell them, those assets will be taxed at lower rates. Not to mention the fact that you will have far more tax deductions, tax credits, and other tax breaks available to you because the government needs businesses. They need real estate investors, and they need other long-term investors to grow the economy, produce jobs, and so on. And we'll talk about those tax breaks in a moment here, but first let's address the other end of the spectrum. So on the other hand, if you only earn W-2 income and own nothing else on the side, like a stock portfolio, rental property, or even just a side business, then you will have very little flexibility in determining how you will be taxed. You will normally be limited to just maxing out your IRA, 401k, or other tax deferred accounts, which, don't get me wrong, can still be very beneficial, but will not allow you to pay the very least in taxes like the ultra wealthy. And by the way, I am not suggesting that you need to quit your W-2 job to save money in taxes, but I am suggesting that you build ownership into an asset on the side that not only builds more wealth for you, but can even offset your overall taxes as well. For example, as a CPA, I work with several high-income W-2 earners, and a lot of them invest into things like real estate or oil and gas companies, which provide such large tax benefits that it ends up wiping out most of the taxes they will pay in one single year. So not only are they keeping more of their hard-earned money, but they are parking their money into assets that will appreciate in value, generate more cash flow for themselves, and lower their taxes to almost zero in some cases. And these are not billionaires, they are just using a framework that allows them to build tax-free wealth, and it all starts with ownership. So that's the first key here. Now, the second key is owning the best type of assets. And by best, I mean assets that allow you to build tremendous amounts of wealth while paying very little tax. So I want to walk you through some of the best assets and the biggest tax breaks available for them. And then we will talk about how billionaires pull money from these types of assets without paying taxes. So let's start with owning a business, because almost every billionaire that we hear about that's paying very little tax actually owns a business. Just think about it. Elon Musk, Jeff Bezos, Warren Buffett, Mark Zuckerberg, and so on all own a business. And you can tap into some of the same very tax benefits that they have by owning your own business, again, even if it is just a side gig or very small business. And here's why. Number one, owning a small business allows you to take over 100 additional deductions and write-offs that will immediately reduce your taxes. And most expenses you incur in your personal life are not tax deductible. But on the other hand, almost every expense you have as a business owner is tax deductible. Business owners can write off almost every type of expense that is related to their business, and can also write off significant portions of their personal expenses, like their mortgage, their rent, their cars, meals, health insurance, and so on. For example, Jay-Z and Beyonce purchased a mansion for almost $100 million. And if they have space in that home that they solely use for their business, like an office space, a media room, or recording studio, which I presume they do, then they can write off the business usage of their home, allowing them to write off their home expenses. And in the same way, small business owners who have any office space in their home, even if it is just a desk, could still take advantage of the same tax provision that is currently allowing billionaires to write off these sorts of expenses. But on top of that, the tax law also grants business owners tax credits that offsets their taxes even more. For example, it is reported that the state of New York offered up to $3 billion in tax credits to have Amazon relocate their headquarters in New York to create more jobs in their region. It is also reported that Tesla received up to $100 million in tax credits or more for building a factory in Austin, Texas. Now, these are just some examples of tax credits that some of the biggest corporations receive from the government that in turn helps them pay very little money in tax. But there are even more tax credits available to small business owners as well that reward them for things like locating their business in certain areas, hiring certain groups of people, researching and building new products, and so on. But you have to first own a business to benefit from these types of credits. Now, there is still one other major tax benefit that business owners enjoy that also extends to some of the other assets that we'll talk about as well, and that is depreciation. Now, put very simply, depreciation allows you to write off some of the purchase price or the cost of any asset you purchase, like equipment, machinery, vehicles, real estate, and so on. Now, by default, these types of purchases are meant to be written off over several years, but there are additional tax provisions in the tax code that allow business owners and have allowed them to write off up to 100% of these types of assets in one given year.
What if I bought a jet? Well, that'd be ridiculous. If I buy this jet, can I write off my entire tax bill? He's like, actually, that would work.
Now, there are even more stories of how billionaires are writing off lavish things like jets, yachts, and more expensive assets to pay very little money in tax, and they are primarily using depreciation to do this. This is also why you may see corporations like Meta, Tesla, and Amazon owning the real estate that they use for their corporate headquarters and other facilities, because by owning these properties, they are able to take very large tax write-offs, often saving them literally millions of dollars in tax, which also reinforces the very first point that I mentioned in this video, that ownership is the key to taking massive tax write-offs. Now, on a much smaller scale or more realistic level, your everyday small business owner can use the same rules to write off their vehicles, equipment they may need, and even office space they need to operate their trade or business. And as they earn more taxable income, they may look at additional assets that they can purchase that will reduce their taxes, whether it is in their business or not. Which perfectly leads me to the next best asset class, real estate. So even if you're not self-employed or own your own business, you can still take advantage of depreciation by owning real estate. And when I say real estate, I am referring to rental or investment property, because when you own investment property, you're basically in the business of real estate, which again allows you to take massive depreciation expense on your tax return to pay less taxes. Now, when it was reported that Donald Trump paid almost no income tax, a lot of my clients came to me wanting to know how they could pay almost no taxes like Donald Trump. And my answer to them was very simple: real estate. It was reported that Donald Trump reported more than $1 billion in rental losses on his tax returns, which he used to offset a very large portion of his income. And a large portion of those losses were actually related to depreciation. So as you can see here, owning property and taking depreciation is one of the most significant ways that the wealthy avoid paying taxes on their fortunes of wealth. But it is not the only way. They can also write off almost every type of cost related to those properties, from the interest expense that they incur on their loans to property tax and many other maintenance expenses. But it still gets even better. The tax law allows property owners to avoid tax even when they sell their properties through something called a 1031 exchange. Basically, this allows them to pay no tax on a property that they are selling if they consequently purchase another property within a specified time period. And this provision essentially allows billionaires to build real estate empires over time without paying any taxes along the way. And thus, ordinary taxpayers can still build towards this by carefully choosing how we invest what is left from what we earn, whether that be through a W-2 job, side business, or as a full-time business owner. Now, to be fair, owning real estate is not for everyone, but fortunately, there are still other types of assets that you can invest in that provide massive tax benefits. For example, when you invest in a qualified private oil and gas company, you can write off up to 85% of your investment in the first year, again, thanks to depreciation and another tax benefit called depletion. And there are also other major tax benefits available to people who invest in paper assets like stocks and bonds, for example. For instance, when you hold your investments for longer than a year, it qualifies for lower capital gains tax rates when you sell it. But you can also take this a step further and shield these types of investments from tax completely by using accounts like a Roth retirement account, and sometimes a traditional account makes sense as well. But usually when we're talking about billionaires, they usually own a mix of all of these assets like stocks, real estate, businesses, and so on. And while they do benefit from all of these tax breaks, there is one strategy in particular that they use to avoid tax completely on these types of assets, and that is called the buy, borrow, die strategy. Now, politicians are so jealous of this tax strategy that they are making proposals to try to tax unrealized capital gains as a way to tax the wealthy individuals that do this. So let's break this down. Now, the buy part of this strategy refers to everything we talked about in this video so far, from building and buying assets like businesses, real estate, stock portfolios, and so on. Now, usually when ordinary people need money to pay for the things they need in their life, they just sell some of their investments if they have them. But what many wealthy individuals do instead of selling these assets and paying taxes is simply choosing to borrow against their assets instead. And when they do this, they pay no tax on the proceeds because it is not considered income. Plus, the interest expense that they pay on those loans are tax deductible, again, lowering their taxes even more. For example, in 2007, it was reported that Jeff Bezos earned $46 million in income, but was able to, quote, write off every penny of it by taking deductions like interest expense. Not to mention the fact that borrowing against these types of assets instead of selling them also allows these individuals to keep growing their investments. For example, their businesses will continue to earn more money if they don't sell them. Their real estate and stocks will continue to appreciate in value as well if they do not sell them. Plus, they will continue to benefit from all of the tax breaks available in these assets as well. Now, ordinary taxpayers have the same luxury of borrowing against their assets as well, and the most simplistic version of this is using a HELOC or home equity line of credit, for example. And for those people with investments, they can also use an SBLOC or securities-backed line of credit. Business owners can take out loans or business loans against their equity as well, and so on. Now, of course, the decision to do any of this stuff should be weighed carefully. For example, interest rates are high at the time of this video, so borrowing against your assets and incurring high interest expense would only make sense if you are using those funds or proceeds to invest into something that would yield a much higher rate of return than your interest expense. And even with that, you still have to weigh out the risk involved with such a strategy. This is why it's good to have a good CPA in your corner who not only understands all of these tax strategies that we've talked about so far, but can also seek to learn more about your unique circumstances and advise you accordingly. And if you need a CPA that you can work with right now, just go to mycpacoach.com to apply to work with one of my CPAs today.